You're 24, sitting across a laminate desk from a loan officer named Denise who has a photo of a golden retriever taped to her monitor and zero interest in your business plan. You need $9,000 for a used cargo van, a 2014 Ford Transit with 118,000 miles on it, and a sliding door that sticks halfway. You want to start a power washing business? Denise runs your credit, taps a pen against a stack of forms, and says the word no like it costs her nothing. Your score is 640. Your income is inconsistent. Banks don't lend on inconsistent. You leave with a folder of paperwork you'll never touch again, and sit in the parking lot with the engine off, sweating through your one-collared shirt. Through the open window of the car next to you, a woman in a quilted vest is on speakerphone with her husband, talking about their son. He's borrowing 18 from the family bank, she says, like it's nothing, like it's a sentence anyone would understand. Halloran Capital will carry him at 4% till the shop turns a profit. She laughs at something you can't hear. She pulls out in a Volvo that isn't new and isn't trying to be seen. You sit there with the word bank stuck sideways in your throat. Not a bank. The family bank. You don't know yet that the Hallorans have been lending to their own kids for 3 generations, that Beckett Halloran's $18,000 came with a signed note and a repayment schedule his grandmother checks at Christmas dinner. You just know you handed a stranger your morning and your paperwork today and got nothing back but a photocopy of your own credit report. 50 years from now, you'll be the one at the head of a long table, reading a promissory note out loud before you sign it, watching a 24-year-old across from you wait on your answer the way you just waited on Denise's. $0 to $500 million. 5 levels. 1 lifetime. It starts here, in a parking lot, with a word you don't have yet. You don't forget the parking lot? You can't afford to. 6 months later, you're sitting at your mother's kitchen table with your sister Neve and your uncle Warwick, and you say the thing out loud for the first time. What if the interest we already pay each other just stayed in the family instead of going to Wells Fargo or Capital One or whoever's holding the note this month? Not a loan from you to them. A pot. Everyone puts a little in, everyone can borrow from it, and when a loan gets repaid with interest, the interest doesn't leave the house. It goes back in the pot for the next person who needs it. Warwick laughs, not unkindly, and pulls a spiral notebook out of the kitchen drawer where the takeout menus live. Fine, he says, we track it in here. That notebook becomes the whole operation. No app, no spreadsheet, just 3 columns in ballpoint pen. Who put in, who took out, what's owed. You start calling it, half as a joke, the family bank. Nobody outside that kitchen has heard the phrase before. You'd only heard it once yourself, through a car window from a woman you'll never meet again. You put in 40 a month, Neve puts in 60, Warwick, who makes more and complains about it constantly, puts in 150. 6 weeks in, the pot holds 760, and Neve's Honda needs a water pump, 600 installed, money she doesn't have and doesn't want to put on a card at whatever rate her card charges her that month. She borrows this 600 from the pot. You all agree, out loud, at that same table, that she'll pay it back over 5 months with a little interest on top, enough to make it feel real. Not enough to punish her for asking. $62 in interest, total. It sounds like nothing. It isn't nothing. It's the first dollar the family bank ever earned, and it goes right back into the notebook instead of into a shareholder's dividend somewhere in Delaware. Something shifts in you watching Neve write her own payment into that ledger every month. Debt, the kind you grew up watching your parents carry, always felt like a leak, money draining out of the house towards some faceless institution that would never once ask how your mother was doing. This is the opposite of a leak. This is water moving in a circle. Neve's car payment isn't extraction anymore, it's circulation. It comes back around to fund whatever happens next, maybe for you, maybe for Warwick, maybe for a kid neither of you has had yet. The pot survives its first real scare 4 months later, when a second cousin, Dash, borrows $300 for a phone bill he swears is a one-time thing and then goes quiet for 11 weeks. No note, no schedule, just a handshake and a text thread that goes cold. Warwick wants to write it off and forget it. You don't. You call Dash, awkwardly, and you get the $300 back in installments of 25 no interest because you never wrote down terms in the first place and you have nothing to point to. That's the lesson, and it costs you exactly $300 to learn it for free. The family bank only works if even a $600 loan between people who love each other gets written down. Amount, date, payback schedule, signed by both sides. Not because you don't trust Dash, because trust is exactly what you're trying to protect, and paper is what protects it. You go back through the notebook that same night and rewrite every entry with a date and a signature line, Neve's water pump included, even though she'd already paid it off in full. Rule number 1, underline twice at the front of the notebook. Nothing leaves the pot without it being written down first. The same week Neve's water pump gets fixed, Your coworker Marisol finances a 55-inch TV at the big box store down the road, $1,299 sticker price, store card, 29.99% APR, same rate on the sticker as the one on her gym membership cancellation fee. She'll pay for that television twice over before she owns it outright. You don't say anything to her about it. You just go home and write 760 in a spiral notebook and feel, for the first time, like you're standing on the other side of a door most people don't know exists. 3 years in, the notebook can't hold what the pot has become. Monthly contributions from you, Neve, Warwick, and now your mother and Warwick's business partner have stacked the fund past 40,000, sitting mostly idle in a savings account, earning almost nothing while it waits for someone to need it. You're the one who needs it. Your power washing business has outgrown the borrowed pickup truck and the garden hose setup you started with, and you need 18,000 for a real rig, a used van, a pressure system, a water tank, signage. Double what Denise turned you down for at 24. And this time the answer, before you've even finished the pitch, is yes. But Warwick, who has quietly become the family's de facto banker, doesn't just hand it over. He sits you down at the same kitchen table with a printed promissory note, 2 pages, and walks you through it like it matters, because it does. The loan amount, the repayment schedule, $340 a month for 5 years. And the interest rate, 5.5%, which Warwick explains isn't a number he picked to be generous or to be a hard ass. It's tied to something called the Applicable Federal Rate, a minimum interest rate the IRS publishes every month for loans between family members. Charge less than the AFR on a loan this size, Warwick tells you, and the IRS doesn't see a loan anymore. It sees a gift, dressed up in loan language, and depending on the amount it can trigger gift tax exposure or just get reclassified outright, imputed interest and all, whether anyone in the family ever meant to dodge anything or not. Charge at or above it, document the terms, actually collect the payments, and it's a real loan in the government's eyes and in yours. Warwick shows you where he pulled the number from, a table published monthly with short-term, mid-term, and long-term rates depending on how long you've got to pay it back. Your 5-year van loan falls under mid-term, and he picked that month's published rate on purpose, not a number he made up over coffee. You sign your name on both pages. Warwick signs as trustee of the fund. It's the most serious your handwriting has ever looked. He tells you what happened 3 Thanksgivings ago, before you were paying attention, a loan the fund made to a family friend's son, undocumented, that went bad and turned into a screaming match over the mashed potatoes that nobody's fully recovered from. No note, no schedule, so no way to point to anything except who remembers what. That's the story that convinces the whole family, finally, to formalize. The pot gets its own bank account that year, separate from anyone's personal checking, with its own routing number and its own statements arriving in a manila folder Warwick keeps in a fireproof box. Simple written criteria go up on the fridge, printed. The loan has to have a purpose, a repayment plan, and 2 signatures before it's approved, not one uncle's gut feeling and not one nephew's charm. The 2-signature rule gets tested almost immediately when your cousin Dash, the same Dash from the 300 phone bill years back, asks for $12,000 to open a food truck with no plan, no numbers, and a shrug when Warwick asks how he'll make the first payment. You and Warwick both say no, in writing, the same way every yes gets written. Dash doesn't come to the next 2 family dinners, and when he finally does, he brings a store-bought pie and barely looks at you across the table. It costs you something real, watching him sit at the far end of the table. But you understand, in a way you couldn't have at 24, that the bank has to be able to say no or every yes stops meaning anything. Rule number 2 goes up under rule number 1. The bank says no, so the family can keep saying yes. Your business repays that $18,000 in full on schedule, plus every dollar of interest, and none of that interest ever sees a bank's balance sheet. It goes straight back into the fund. That's the part that changes everything downstream. Not the van, not the business, but the fact that the money you paid to borrow became the seed for the next 20 people who'd need to. By the time the fund crosses $250,000, the fireproof box and the manila folder aren't enough anymore, and neither, honestly, is Warwick doing it all from his kitchen table on weekends. You sit down with a lawyer your business accountant recommended and turn the family bank into what it's actually already become, an LLC, with an operating agreement that spells out capital accounts for every member who put in what, over what years, and what share of the fund they hold because of it. There's a loan committee now? 3 people instead of one uncle's gut feeling, you, Warwick, and your mother, rotating in a 4th seat every 2 years, so no single branch of the family controls the yes or the no forever. There's an annual family meeting, first Sunday in November, still held in your dining room with the leaf put in the table because none of you can imagine holding it anywhere else, even after the fund is worth more than the house it meets in. The bigger question, once there's real money sitting between loans instead of flowing straight out the door, is where it sits. You learn the term capital warehousing from your accountant, and it becomes the second education of your life. Money waiting to be lent shouldn't just sit in a checking account earning nothing, but it also shouldn't be swinging in the stock market the week your niece needs a down payment. You split it three ways. A slice in short-term treasuries, boring and liquid, for whatever gets asked for on short notice. A slice in a conservative brokerage account for the money that won't be needed for years. And a smaller slice in a permanent life insurance policy on Warwick's life. Cash value building slowly, tax-advantaged, a warehouse you can borrow against without disturbing the policy itself. Not a miracle machine, not to become your own bank pitch some guy with a ring light will try to sell you later. Just one more conservative bucket among several, chosen because it does one job well and doesn't need babysitting. Your accountant is blunt about it at the meeting where you decide the policy is a stable, low-volatility place to warehouse a slice of capital and a way to get a death benefit into the fund eventually, nothing more mystical than that. And anyone selling you the infinite part of infinite banking is selling you a feeling, not a mechanism. The lending changes shape too. Instead of covering TVs and phone bills, the fund starts funding first homes and first degrees. Your niece Junie needs a down payment on a starter condo, and instead of gifting it or co-signing a bank mortgage that pays a lender's quarterly bonus, the family bank writes the whole mortgage itself. A real amortization schedule, a real rate above the AFR, a lien the fund actually holds, recorded at the county courthouse, with the fund's LLC name on the paperwork like any other lender in town. Every payment Junie makes for the next 20 years builds the pot instead of some regional bank's earnings report. It's the same shape as your $18,000 van loan, just bigger, wearing a suit now. The governance catches up last, and it's the hardest part. You draft a family constitution, a document, not a contract, spelling out what the bank will fund and what it flatly won't. Business capital, education, first homes, medical emergencies with a repayment plan attached. Not lifestyle upgrades, not bailouts with no plan behind them, no matter who's asking or how good the excuse sounds. Warwick fights you on that last line in the November meeting, loudly, standing up at his end of the table with the leaf in it, because he's thinking of a specific person, and you both know who, a nephew mid-divorce, who needs $40,000 to keep his house and no plan for how a fund loan changes anything about the spending that got him there. It's family, Warwick says. That's the whole plan, is that he's family. You hold the line anyway, and it's the first time in your life you've had to be the wall instead of the water, telling your own uncle that a fund with no rules for what it won't fund isn't a family bank, it's just a family with worse boundaries and better cash flow. You cross $1 million in the fund the same year your knees start aching climbing the stairs to check the mail, and you notice, for the first time, that this thing you built at a kitchen table is going to outlast the knees that built it. Your knees keep aching, and then it's your hip, and then it's an afternoon in an estate lawyer's office you didn't expect to need for another decade. Marguerite Sten has a corner office and a way of saying hard things gently that you appreciate more with every sentence. The fund is worth just under $6 million now, and Marguerite tells you plainly, if you die tomorrow the way things currently sit, a meaningful slice of it gets taxed at your death, the rest gets probated in open court for anyone to see, and your carefully built loan committee has no legal standing to keep operating the way it always has. A family bank that only exists because you personally hold it together isn't a family bank. It's just you, temporarily. Marguerite says it plainer than that. Actually, everything you built at that kitchen table with a spiral notebook was designed to outlive one default, one bad Thanksgiving, one nephew's shrug. None of it was designed to outlive you. That's the gap she's here to close. The fix, Marguerite explains, is a dynasty trust, a trust structured in a state like South Dakota or Nevada to run for a very long time, far longer than trusts are typically allowed to last in most other states. Some of them designed to hold assets across generations without the fund being forced to break apart, get taxed again, or get divided up at each death the way it would in a state with older trust duration laws. You don't move to South Dakota. You never set foot there. The trust is simply chartered under that state's laws, with a trustee empowered to administer it, while the fund itself, the LLC, the loan committee, the whole operating machine sits inside the trust and keeps running exactly as it always has. Warwick, older now and slower to argue than he used to be, still shows up to every loan committee meeting, because the trust owning the LLC changes who's legally accountable, not who's actually in the room deciding whether a grandkid's request gets approved. The trust owns the bank, the family still runs it. Alongside the trust, you and Marguerite set up a family limited partnership, a structure that lets you gift shares of the fund to your kids and eventually your grandkids over a series of years, a little at a time, using the same kind of annual gifting allowances any parent can use, rather than handing over the whole thing in one taxable, chaotic lump at your death. It's slower. It's also the whole point. Marguerite draws you a simple picture on a legal pad, leave a child money outright, and you've handed them a number that only shrinks from the day they get it. One bad year, one bad marriage, one bad friend with a business plan away from zero. Leave them a partnership interest in a system with a loan committee, written criteria, and 2 signatures required, and you've handed them something that regenerates itself long after any single number would have run out. You're not leaving your children money, you're leaving them a system with rules already stress-tested by 2 defaults, 1 Thanksgiving blow-up, and a cousin who still shows up to dinner a little late. Your daughter Isla takes over the loan committee the year you turn 70, and you watch her do something you couldn't have done at her age. Her own brother, Foster, asks the committee for $90,000 to expand a restaurant that's already bleeding money quietly for 2 years, and Isla, in front of the whole family, tells him no kindly in writing, with the actual numbers laid out on paper so nobody can call it favoritism or spite. He's furious for a season. The rules hold anyway, the way they held when you told Dash no decades earlier, and you realize watching her that the bank has officially outlived being about you. The grandkids start showing up to the November meeting with actual pitch decks now, applying for what the family started calling first venture loans, a nephew's daughter with a business plan for a mobile veterinary practice, a cousin's son with numbers for a small solar installation company. The fund quietly crosses $50 million the same year, and not one person outside this dining room has any idea it exists. No press, no plaque, no name on a building anywhere. Just a family that stopped needing anyone else's money 2 generations ago. By the time the fund passes $500 million, it isn't a fund anymore in any sense the word used to mean. It's a single-family office now, its own quiet suite of rooms above a bank branch neither you nor anyone in the family has ever borrowed $1 from, with salaried staff who do nothing all day but manage this one family's money, an investment director, a controller, a client services person whose entire client list has your last name on it. Above that sits a private trust company, chartered by the family itself, so that instead of paying an outside institution to serve as trustee of the Dynasty Trust, the family is the trustee, licensed and regulated to act as one, the way a handful of families have quietly done for over a century. Marguerite, long retired now, told you once about the Rockefellers doing exactly this generations ago, an entire floor of a building in Manhattan, room 5600, that existed for no other purpose than managing one family's capital and training the next generation to keep managing it. You didn't believe, sitting in her office at $6 million, that you were looking at a smaller version of the same idea. You believe it now. From inside, $500 million looks almost nothing like what you'd have guessed at 24 in that parking lot. There's no yacht with your name painted on the hull. There are investment policy statements reviewed annually, spelling out exactly how conservative or aggressive each pool of capital is allowed to be and why. There's a next-generation education program, mandatory, that every descendant sits through before they're eligible to sit on the loan committee, how to read a balance sheet, how to read a term sheet, how to say no to your own sibling with the numbers in front of you instead of just a feeling. There are, at last count, a little over 100 descendants across 4 generations, and every single one of them has a banker inside the family office who shares their last name and picks up the phone personally. The full circle happens on an ordinary Tuesday. Your granddaughter Sloane sits across the committee table. Isla runs it now, you're mostly ceremonial, invited more than needed, presenting a loan request for a marine biology consulting practice she wants to start, spreadsheets printed, a repayment schedule she built herself. She's 24. The exact age you were the day Denise told you no over a laminate desk and a stack of forms you never needed again. You watch the committee ask her the hard questions, the ones that used to be Warwick's alone to ask, and you watch her answer every one of them without flinching. The family bank says yes, on terms, a real rate, a real schedule, 2 signatures, the same shape of yes that has never once changed in 50 years, and then they hand the note to you, the one ceremonial job they keep you around for. You read it out loud at the head of the long table, every clause, the way it's always been done, and Sloane signs a promissory note that looks, if you squint, almost exactly like the one you signed for $18,000 in Warwick's kitchen a lifetime ago. You could recap it in one breath if anyone asked, and sometimes at family dinners, someone does. A $600 loan in a spiral kitchen drawer notebook. A promissory note for a van, an LLC with an operating agreement and a loan committee. A dynasty trust that doesn't die when you do. A private trust company with your family's name on the charter. 5 levels, 50 years, 1 lifetime. But the real asset was never the $500 million, and you know that better than anyone left alive who remembers the notebook. The real asset is that the interest, the discipline, and the trust simply stopped leaking out of this family and into strangers' balance sheets 1 generation at a time, until it compounded into something none of you could have written down on a single page. The notebook itself still exists. It sits under glass now, in the family office lobby, ballpoint pen fading, 40 and 60 and 150 entries in handwriting that used to be yours, right next to the 2-page note that started everything real. Nobody dusts it for show. Nobody explains it to visitors, because there aren't any. It's just there, the plainest thing in the whole office, proof that the real bank was never the building above the branch. It was 3 columns in ballpoint pen, and a family that decided, at a kitchen table, to stop paying strangers for the privilege of trusting each other.